Hi folks, thanks for joining the webinar today. It's great to have you here. For today's webinar, we've got Nat Dennis-Weller, who's the manager for the Financial Assessment Unit, here with us today. And as always, we've got some great support behind the scenes as well from the Education and Engagement team and also the Financial Assessment Unit as well. My name's Harm and I'm the Education and Events Coordinator with the QBCC Education and Engagement team. So just before we get started, QBCC acknowledges the Aboriginal and Torres Strait Islander traditional custodians of country throughout Australia and recognise the continuing connection to lands, water and communities. We also pay our respects to Aboriginal and Torres Strait Islander cultures and to elders past and present. Okay, on to housekeeping. Okay, so at the end of the webinar, folks, you'll get a survey that'll be asking for your feedback. Please take a couple of minutes to complete that survey, as it really helps us bring you the content that you expect and that you value as well, which is very important to us. For audio settings, if you're using a mobile device and you can't hear the sound, please check your device settings. So for Android users like Samsung or Google, for instance, press the volume buttons to turn up the volume as normal, but this time adjust the media channel volume. Most of you shouldn't have any issues, but if you can't hear, make sure you adjust that media volume on your device. For questions, okay, so for questions, if you've got any questions, please send them through via the chat box that you can see on the slide that we've got up on screen. You can see that chat box in the picture there. Excuse me. And if your question isn't addressed, rest assured, we've got a record of questions asked during the session, and we'll do our best to respond to those as soon as we're able. Okay, well, on to the star of the show, and we'll head over to Nat to get into the presentation. Nat, are you there?
I am, Harm. Thank you.
Great, no worries. I'll disappear into the background.
All good?
I sure can, absolutely. And just let me know when you need those slides changed, and we'll go through those for you.
Excellent, thank you. So hi everyone, Natasha Dennis-Weller. As Harm mentioned, I head up the Financial Assessment Unit. So that unit essentially has three streams to it. So my team does all things annual reporting related. So we take the lodgements of those annual reporting submissions, and we also do the assessments of those after they've been lodged. We have a second stream which includes the financial assessment component of all new license applications in the building industry, so when you first start out, and also the maximum revenue upgrades and downgrades that you might need at some stage during the year. We also have a third stream which is smaller but equally as important, and that's our regulatory arm within the Financial Assessment Unit. So we would audit or do show cause notices or suspensions, cancellations of licensees who we think may be suffering from some financial difficulty. So they're the three streams of the Financial Assessment Unit of QBCC. But that particular team that I head up also forms part of a financial compliance branch within the organisation. So I thought I'd just quickly touch on some of the other areas that QBCC are currently involved in within the financial area. First one being project trust accounts. At the moment, this is for state government contracts 1 mil to 10 mil or private contracts 10 mil or over. I think there's some other things like hospitals and aged care, but it is quite limited to those things. So essentially the head contractor needs to put money into the project trust account to pay all payments to subcontractors, and that also includes the separate retention trust account. Some exemptions do apply to that, whether it's civil works or engineering, but there is further information on those exemptions which are available on QBCC website. Thanks, Harm. Money's owed complaint, this process hasn't really changed. It's still essentially based on a licensee needs to pay their debts as and when they fall due. That includes to subcontractors and suppliers for any debt that is for owing by that licensee. There is a couple of disclaimers to that. First being that if the debt is disputed, or secondly, if it's part of a legal process, whether that's through the court or adjudication process, QBCC can't become involved in that. So we're not an adjudicator and we can't settle disputes between parties. If there is no dispute and the debt isn't party to legal proceedings, then that licensee needs to pay the debt as and when they fall due. So that it has been quite a successful process, the money's owed complaint process. So what I would say to licensees, or if someone is owed money by a licensee, to make sure that they do avail themselves of that particular process. It is available through the QBCC website, and it's a fairly easy process. It does need to be supported by documentation, so payment claims, invoices, things like that, to assure that the debt is actually owing. Thanks, Harm. The exclusion process, this one is a fairly serious provision. It also hasn't really changed over the last couple of years. Essentially, if a licensee has an insolvency event, whether that's bankruptcy or liquidation of a company, that particular licensee or director can face exclusion from the building industry for a period of 3 years. If by some reason they come back into the industry after that exclusion period of 3 years and they face a second exclusion, so a second insolvency event, they could face exclusion for a lifetime. So it is a fairly serious process, and obviously the government takes insolvency events fairly seriously. Thanks, Harm. But the main reason that I'm here today is to talk about the minimum financial requirements. So that process involves the annual reporting and any financial component to holding the license. Why do we need them? So behind every law that's made by the government of the day, there is an intent, and this piece of law is no different to that. So the intent behind the financial requirements are to promote financially sustainable businesses within the building industry. We often get criticised about why QBCC hasn't stopped an insolvency, hasn't stopped someone going into liquidation or administration. That we can't do that. It is a totally legal avenue for a licensee to go into liquidation or administration. It's actually a director's duty. If that licensee or if that business is insolvent, they do actually need to place it into liquidation. So the minimum financial requirements can't prevent that. They can't stop that from happening. The minimum financial requirements are in place to try and minimise the damage to the industry if an insolvency event does occur. I would always draw the analogy that your QBCC license is very similar to holding a car license. So when you first start out driving a car and you pass these tests to be able to drive your car, there are all these laws in place surrounding you driving the car. So you can't talk on your phone, and you've got to go a speed limit, and you've got to wear a seatbelt, and you can't go over 40 through a school zone. Those laws are in place not to stop you from having a car accident. I can still drive my car at 10 kilometres an hour and have a car accident. Might not be a very good driver, but I can still have a car accident driving 10 kilometres an hour. All of those laws behind driving a car is to minimise the damage if you were to have a car accident. So it minimises the damage to yourself and your car, pedestrians, other vehicle users of the road. So that's essentially what the minimum financial requirements are in place for. They're to prevent or try and minimise the damage to the industry if a licensee was to become insolvent. Particularly now that we have the annual reporting requirements through, we can see trends and concerns a lot more readily, a lot more quicker, and we can draw the analysis behind those trends. So if we are able to identify that a licensee is having some financial difficulties, maybe showing some concerns with their financial position, we can step in a lot quicker, and we can either bring that licensee back into compliance, or unfortunately we might put them out of the industry, maybe suspend the license until that happens. But that's to ensure that, the reason that we would do that is, instead of a licensee going into insolvency for $10 million, if we've stepped in early enough, they might only go broke for $5 million. And yes, there's still going to be $5 million worth of hurt to the industry, but we've prevented that extra $5 million from happening. So that's the reason behind, or the intent behind, the financial requirements that are in place. Thanks, Harm. What are the minimum financial requirements? They're essentially made up of three things. And again, there's reasons behind those three main requirements that are in place. You might hear the term current ratio. What that means is that you've got to have enough assets, enough cash, enough things that you can turn into cash in order to pay your debts, in order to pay your bills that are currently outstanding. So that's the liquidity of your business. It just gives a very quick test as to whether or not you've got enough capacity to be able to pay those bills when they're due. Your net tangible assets are something different. So essentially, if you sell all of your assets today and pay out all of your debts, all of the bills that you are owing, what's left over is your working capital. So that's what your net tangible assets are. Essentially, what your business is capable of, or what your bottom line is. Your net tangible assets fits in to the maximum revenue. So your maximum revenue is the ceiling that you can do, the maximum amount that you can turn over based on your net tangible assets that you hold. So what we don't want is a builder to be turning over $50 million if they've only got $5,000 worth of working capital. There's a bit of a risk there. So those two things work hand in hand. Your net tangible assets set the maximum revenue that you've got, and the maximum revenue that you're allowed to do is based on your working capital. If you're ever unsure of the assets that you need to hold or the maximum revenue that your assets will give you, if you head to the QBCC website and type in maximum revenue calculator, there's a good tool there that does both of those things, either one or the other. It can tell you what your net tangible assets are required to be for the turnover that you want, or it will tell you your maximum revenue that will be set based on your net tangible assets. So those two things work quite hand in hand. Thanks, Harm. Annual reporting versus an MFR report. So very similar things, but also very separate things. Annual reporting, it's a once a year submission. You need to do it every year, and it needs to be by set due dates. It doesn't need to be prepared by your accountant, and it doesn't need to have accounting standards applied to it. So it can be based for categories 1 to 3, which is most of our licensee database. It can be based literally off your internal management accounts. So that could be whatever internal system you use, whether it's QuickBooks or Xero or MyOb, straight off that system, that's totally fine. Whilst we say it doesn't need to be prepared by an accountant, we would recommend that you do go and see your accountant, not just for annual reporting, not just because of QBCC, but if you're running a business, it's really good to have that professional that deals with the finances to be able to give you the guidance that your business might need. Annual reporting doesn't need to have an MFR report provided to it. It's literally just those that information that has come straight off your internal systems. An MFR report is that higher threshold. It's only required in certain circumstances. When you first start out and you apply for a license, it's likely that you'll need an MFR report when you first start out. You may never need to provide QBCC with another MFR report for as long as you remain in business. If your turnover doesn't increase by more than 10%, or your assets don't decrease by more than 20 or 30%, if your business structure doesn't change, and if we never request it. So it's a very small list of the circumstances that you would need to provide an MFR report to QBCC. Thanks, Harm. So again, annual reporting, it has those set due dates. It's based only on your most recent financial year end date. For pretty much all of our licensees, your financial year end date is 30 June. There's a few larger licensees where they might have, there might be national or international based companies or corporate entities. Their financial year end date might be 31 December. But for pretty much the majority of our licensees, your financial year ends on the 30th of June. So we're just about to come up to that at the moment. They are set due dates. So categories 1 to 7 have 31 December due date, and categories SC1 and 2, the smaller end, have the set due date of 31 March. The reason that those dates were picked, 31 December, it's not an ideal day for anyone. Most of the building industry shuts down over that time. The accounting industry is shut down. QBCC is shut down. It is a public holiday, or at least the next day is a public holiday. The reason that the 31st of December was picked for the annual reporting day every year for those license categories is to provide that middle ground, somewhere in between allowing enough time for your 30 June information to be prepared and it to be recent enough for QBCC to look at. There's no point providing QBCC with financial information that's 10 months old or 18 months old. A lot can happen in that time. So at least if it's 6 months old, by the time we get it and have a look at it, it's recent enough for us to be able to establish whether your business is tracking in the right in the right direction. 31 March was picked. The reason that was picked for the smaller contractors, SC1 and SC2, most licensees in those categories are seeing their accountant to get their tax done at the same time. So it was trying to kill those two birds with one stone. So again, just trying to provide that sweet spot and allowing enough time for the accounts to be prepared and enough time for QBCC to rely upon it. Annual reporting doesn't change your maximum revenue. So the maximum revenue that you get when you either upgrade your turnover or are first licensed within the building industry, annual reporting doesn't change that. Only the MFR report would do that. Important to note that the MFR report, again, only needed in those certain circumstances, which is not very often. It's a lot more stringent. Your accountant does need to sign off on that report. It can be provided at any year outside of your financial year end date, but it can't be any older than 4 months old at the time that it's submitted to QBCC. Thanks, Harm. Why do I need to give QBCC my financial information? Very good question. It's definitely not for our entertainment, I can tell you that. It is a law. It's a law that's set in place, rightly or wrongly. It is a law that you need to abide by. But more important to that, it can have some really positive outcomes for your business. So by looking at your financials at least once a year, you can see whether there's any pitfalls that are coming towards you or whether there's any improvements that you can make in your business. You might be able to see what your profit margins are. You might be able to see whether or not your expenses are too high. So it can identify those areas of improvement and perhaps pitfalls for you if you weren't doing it previously. We would probably say do it a little bit more often than once a year, but if it's at minimum once a year, you should be able to have a look at it and see whether or not you are experiencing any difficulties or whether your business is increasing to the degree that you need to go to your accountant and maybe get some professional assistance to guide you through that process as well. Thanks, Harm. Difference between not lodging and not meeting. These ones are very, very different. So not lodging, if you don't lodge your annual reporting information by that due date, whether it's 31 December or 31 March, the government's given us that message that it is really important to do that by the due date. If you don't do it by the due date, you could face some action on that license, whether it's suspended or cancelled. We don't want to do that. We would prefer obviously not to do that, but it is very important to ensure that you do lodge by that due date. Very different if you lodge your information and it doesn't meet the requirements. That's a totally separate process. And I know there is the concern or maybe even misconception within the building industry that we will take action if you don't meet the requirements. That's not the case at all times. So we're a risk-based regulator. We will only take regulatory action if there is a risk to the industry. And by that I mean if you're meant to have $45,000 or $46,000 net tangible assets and you've got, let's say, $38,000 net tangible assets, so you're short, we will go and do some searches in the background and we'll see whether there's any risk there to the industry. If we can identify that there's either no risk or very low risk, it's likely that we would just let you know that we've recognised that your assets may be a bit lower than they need to be. Maybe go and see someone if there's any areas for improvement that you can do to your business. but we've let you know that you don't, that you might be short of those assets. See you next year. Compared to if you're a $50 million company, significant risk there. You've got a lot of creditors, you've got supply accounts, you've got employees that rely upon you, you've got trade creditors that rely upon you for payment. You might be short of $1 million net tangible assets. It's likely that we may take action because the risk is a lot higher to the industry if we don't. So we will, before we lead out with a regulatory action, and by regulatory action I mean we'll either commence a financial audit, or we might give a show cause notice saying we've got these concerns and we're proposing to suspend your license. Before we do that, we'll look at all of these other risks or factors that that we will ensure are present or aren't present before we take action. So we'll look at the harm that could happen to your license, to yourself, to your employees, compared to the, if we were to take action, compared to the harm to homeowners, subcontractors, suppliers, if we weren't to take action. And we need to take both of those things into account before we were to lead out with a regulatory action. Thanks, Harm. We'll also see whether or not you've got a history of non-compliance. So whether or not we've told you a couple of times previously that you may not meet the requirements, you should go and see someone, you should do some steps to improve your business. We'll see whether you've got a history of non-compliance. We'll also see if there's other concerns in the background. Are there monies owed complaints, defective work, non-completion claims? As I said, do you have a history of that non-compliance? Probably the most important one though is if we lead out with a regulatory action, what we're looking to see is a plan for you to come back into compliance. What are you going to do to bring that business back into a positive financial position? What we would not be looking at is an answer in 4 or 5 years' time, 2 years' time, 18 months' time. There's a lot that can happen in that time frame. So we'll be looking to see that you're going to come back into compliance in a reasonable period of time. And reasonable is obviously subjective, but one thing that we probably wouldn't take into account in that plan to come back into compliance is your future cash flow, your future contracts. The main reason that we would tend not to consider that information is because we work in the building industry. Sometimes if you're $1 million short and you've got a $5 million contract that's coming and it's in the future, you're not necessarily guaranteed that $5 million. Anything can happen on that contract. You might have variations, you might have a dispute with the developer or the homeowner, so it's not guaranteed that you're going to rely upon that cash flow to fix your current position. So what we'd be looking for in that plan to come back into compliance is some things that you could do to improve that position, whether it's injecting capital or forgiving loans or doing something that can improve that company's or business's financial position to ensure that it is in a better place for the building industry. Thanks, Harm. Some of the common issues that we see with annual reporting lodgements, there's a couple there. The incorrect financial year end date does need to be that 30 June financial year. Missing signatures, we can't accept it if you haven't signed off that it's yours. Double up of submissions, we don't tend to see those as much as what we used to do. The portal is now locked, you can only lodge it once. We were seeing, up to 17 submissions. People couldn't remember if they'd lodged or not, so they'd go back and lodge again. The portal has now been locked, both internally and externally. You can only lodge once. If you think that you've lodged and you may not have done the right figures, maybe something's come to your attention, that's okay. We can amend it at the back end if we need to, but don't forget, we'll only ask you those questions if we've got concerns in relation to your financial position. So we may not have an issue with what you've actually lodged. Thanks, Harm. Some more things that we see with annual reporting lodgements, trying to submit for an incorrect license category. You can only lodge your license, your annual reporting information for the current category that you're in. If your turnover is too high and you've been set as a category 3, so up to 30 mil, but you actually only want to be an SC2 up to 800,000, that's not through the annual reporting process. That's where your MFR report comes into play. I'm not sure if it's a common one, but your license category is not your actual turnover. So your license category is the maximum you can do. If you're an SC2, you can only trade up to that 800,000, which is your maximum revenue. We don't expect you to go out and turn over 800,000. You can turn over anything from 0 to 700, or actually 800,000 on the dot, within that license category. The other one is the license renewal. It's no longer part of the annual reporting or a financial component of your license. Your license renewal is literally just the payment of a fee. If you've paid the fee for your license renewal, that does not mean that you've complied or lodged that annual reporting information. Two separate issues, two separate requirements that you need to go through to hold that license. Thanks, Harm. Do I need to only report my Queensland construction income? No, it does need to be all of the income that you've earned through that financial year. So it's not just in Queensland, and it's not just in the construction industry. So again, behind every law has an intent. The intent behind having to report all of your income is that some of the income that you earn outside of the building industry, maybe you've got a hairdressing business on the side. If that hairdressing business has some concerns, maybe your rent's too high, your employees are too high, or you're not getting the income, the customers through the door, that can come back and impact the building business of your company if you were running those two businesses within that company. So that's the reason that all income needs to be reported, because it can affect your building business, even if it's outside of Queensland and even if it's outside of the construction industry. Thanks, Harm. I won't go through trust structures in too much detail, other than to say QBCC doesn't license trusts. The main reason for that is the trust is not a legal entity. It can't be sued. It's the trading entity, but it's not the legal entity. The legal entity is either the corporate, the company, the Pty Ltd, or the individual, the sole trader that may be trading through that trust. So that's the reason that the assets need to be held in those entities, either the corporate entity or the individual entity. A trust usually is set up to protect your assets. Unfortunately, in the building industry, you do need to hold those assets to hold the license. That's the reason that the trustee, the corporate entity, or the individual needs to hold those those assets. Otherwise, you'd need to rely on an assurance from the director's personal assets, really not protecting your assets then in that case. So just be mindful of that if your accountant is talking you through that process of setting up a trust for your business. It does have some ramifications on your QBCC license that we might need to step through with you. Thanks, Harm. We've got to the end. Nice. I wasn't expecting that. That came around very quickly.
So we've made it to the Q&A. Thanks very much for that, Nat, by the way. Fantastic information. Really great car analogy as well earlier in the piece. It was fantastic.
Excellent. I hope that made sense to people.
Absolutely. Also, just quickly, thanks very much for your questions. Excuse me, Daniel, and apologies for my pronunciation. I think it's Tusi, Mikel, Teresa, Paolo, and Elise. There's a few more people obviously that have put through questions. So I guess we'll get started with the questions if that's okay with you, Nat.
Absolutely, fire away.
Okie doke. Okay, so first question we've got for you is, if I have lodged financials for upgrade, but they are taking some time to get assessed, will I get penalised?
Good question. And we do get this question sometimes, not all that often, but sometimes. Short answer is no. So no, it's not an offence provision if you breach your maximum revenue. It is a breach of the minimum financial requirements, but it's not something that we would fine you on. The breach is alleviated, so the breach of your maximum revenue is alleviated to some degree when you lodge that financial information. So the onus is then on us. If we've received that information, we will assess it. It'll get allocated for assessment. You can continue to trade in that meantime. So there's no detriment to your business. You don't need to stop working just because you've lodged that information and are waiting for us to assess it.
Great, thanks, Nat. We've got another question here for you. Question is, One received once, okay, I'm going to say once received through pre-registration, what assets are required and what can they be?
Another popular question. So QBCC is bound by law. We have to enforce the law that we're governed by. The financial requirements set out what assets can be accepted and unfortunately what assets have to be disallowed. And again, there's intent behind that. I won't go into too much detail in relation to the intent behind that, but essentially it's things, the assets that are included or can be included as an asset for QBCC purposes are things that you can essentially either turn into cash or turn into cash one day.
Right.
So the common ones are motor vehicles, property, commercial or residential property that you own. It might be the debtor amount, so you've invoiced a client and are waiting for that payment, or work in progress, so you've done the work but haven't yet included it, haven't yet invoiced it. Cash is a good one. Tools of trade, they're acceptable. So those ones are the more popular ones. The ones that have to be disallowed through the law, cryptocurrency, and again, I won't go into too much detail on that, but it's a bit controversial as to whether or not you can actually cash it in for the amount that you bought it for. Racehorses, another good one. Furniture used for personal uses or personal purposes as opposed to office equipment. Office equipment, part of your business. Personal furniture, your couch, your bed at home, they're not required for QBCC purposes. Probably the other one, superannuation benefits. If you haven't yet retired, you might think that you've got this, great money invested in superannuation. You can't actually access that until you are actually retired. So that's the reason that QBCC couldn't recognise that one as an asset.
Gotcha.
I
Great.
should
Thank you.
probably say they're not the extensive list.
Right.
If you are looking at what is included and what's not included, head to the QBCC website. You might find a bit more information on those 2 points.
Great. Thank you. Okay, so we're getting another question here. Are there any particular areas QBCC focuses their attention on?
I assume that means when we take action, if we're concerned. As I mentioned previously, we are risk-based, so we will turn our attention to where there is concern. Maybe your current liabilities are a lot more than your current assets, and we've received some money's owed complaints, so we've received concerns from your creditors that you aren't paying. We might lead out with a regulatory action. But essentially, we look at the risk. We also look at the turnover that you do. 50 million turnover is a whole lot higher than $500,000 worth of turnover. So we'll try and establish what the risk is to the industry before we take action. That's what we would focus our attention on.
Great, thanks, Nat. And sorry about the rapid fire questions, but here's another one for you.
No, all good.
Okay, the question is, it always seems to be bigger companies running into problems and collapsing. Why do small contractors need to have financial requirements?
Another good question. Yes. Without sounding bureaucratic, fortunately or unfortunately, it is the law, rightly or wrongly. But it's also to ensure that whether you're a small business or an ultra large business, you would still have creditors. You would still have people that rely upon you for that payment, and you may still come into problems if you don't pay them. And whether that's a homeowner, whether that's a supplier or a subcontractor or your own employees, if you're running a business, it's likely that someone will rely upon you or your financial position of that business to be sound, to be stable. So that's essentially the reason why not just big, large corporate entities need to report to QBCC, your mum and dad companies also need to for that same reason. It might be on a smaller scale, the risk might be smaller, but the intent behind that is still the same.
Right, gotcha, thank you. Okay, on to the next one. And thank you again for sticking around for the Q&A and answering all these questions, Nat. The next question
You told me
is...
I had to, Harm.
No. Thanks again. Okay, next question we've got is, do I need an individual license if all of my income is wages with the company license? Oh, sorry, the company licensee. I'll read that again,
Do
actually.
I?
Do I
Yeah.
need an individual license if all of my income is wages with the company licensee?
I'd need a little bit more info from the person that's asking that question, but
Gotcha.
essentially, a company needs to have a nominee to be licensed to hold that company license. The company provides the financial support, the nominee provides the technical support, the know-how, the standard of the work that goes on site, on the building site. Do I need an individual license? Not necessarily. If you're only employed on wages from that company and the company has its own nominated supervisor, no. If you're running contracts in your own right, so you're not just working for the company, but you might be doing, I don't know, contracts on the weekend or outside of that company, yes, you would. But essentially, if the company holds also has a nominee supervisor, you wouldn't need to hold your own contractor's license if you were an employee of that company. But I'd probably, for that particular, if that person is online now, maybe contact our call centre 139 333 to maybe flesh that out a little bit more of your actual circumstances. They'll be able to guide you as to whether or not you need a license.
That's great. Thanks, Nat. And great advice too to ring the call centre to get it to sort of flesh that out a little bit more. Also, just a quick acknowledgement for some questions that have come through. Thank you for your question, Audrey. Thank you, Nada. And also thank you, Grant and Mark, for your questions. We'll try and get to those as soon as we can, but we'll press on with the questions that we've already got here at the moment. So the next question that we've got is, why is SC1, so self-certifying, why is self-certifying 1 and SC2 categories not on a sliding scale like categories 1 to 7 with regards to net assets?
I can only make an assumption on that one, because again, the government sets down those requirements. I'd imagine that due to the fairly low turnover amounts and the corresponding net tangible assets required for those license categories, might have been presumed that it was considered appropriate for those to have a bulk net tangible asset amount rather than a sliding scale. That's probably the best way that I could answer that one.
That's great. Thank you, Nat. Okay, we've probably got time for a couple more questions. So what have we got? So the next question we've got is, we operate a trust with a company as a trustee. Do we lodge annual reporting for the trust or the trustee, as the portal will only allow one?
Yes, it will. So it would be, for your annual reporting purposes, it would be the trust. It's the trading entity that would lodge that financial information. When you go to either lodge online through the QBCC portal or either manually on the form, there is a specific component to that annual reporting lodgement where it asks you for your business structure. You would say something similar to, I can't remember the exact wording, but something similar to, my business is a trustee trading through a trust. So at the back end, we can then recognise that we're looking at the trust in that financial assessment component as the trading entity, and that we've got the trustee in the background.
Right, fantastic. We've probably got time for maybe 2 more questions. So we've got a question here. I've lodged, but I don't think I did it properly. Can I amend this once lodged?
I'm hoping I covered that earlier, but essentially you can't, once you've lodged it online or even manually, you can't relodge it. So we can't, we won't, the portal won't allow 5, 6, 7 submissions. Once you've
Sure.
lodged, it's lodged. You don't need to panic if you think that you've made an error, or you might remember some information later on that you needed to put on that form. That's fine. Email us. There is an email address either on the form, or I think there's also one online to the annual reporting email address. We can fix that up at the back end, but you don't need to panic. As in, if you've left something off the form, it's likely we will only ever ask you that question if we have concerns in relation to the information that you've provided.
That's fantastic, Nat. And I think we've got time for maybe one more question. So this is a very
Sure.
general question. So, and this is from us. So since you've been around the state recently, delivering this presentation to folks in regional areas, what are the two main things that you would want attendees to this webinar to take away?
Oh, my answer is twofold. Number one, if you are running a business, it's really, in my humble opinion, it's very important to have a professional in your back pocket. We would say have a lawyer, have an accountant. Hopefully you'll only need one of those. Hopefully it won't be your lawyer. Make sure that you do have someone that you can rely upon if your business is growing, or you need to recognize those pitfalls. And second, twofold, if your business is, unfortunately, particularly at the moment with the government, the current economic climate, we are seeing a lot more materials go up, labour shortages, things like that. If your company is, or you've recognised that your company is suffering or starting to see some trends that are concerning in relation to your financial position, don't leave it until the last minute to go and ask someone professionally for some help, some advice, some assistance. And it doesn't, when I say professional, there are definitely organisations that are within the community that offer free services. You can get free financial counselling if you need it. There's definitely mechanisms available. You don't need to go and see, an accountant that's going to charge you $50,000 for a piece of advice. You can see people that are readily available that can do that for you if you need to. Don't leave it until the last minute.
Thanks, Nat. That's fantastic advice, I'm sure, for all our attendees here. Look, we've come to the end. Thanks once again, folks, for your attendance. Nat, thank you very, very much for the presentation and also the Q&A. Folks in the background that have been running all the bits and pieces, thank you once again. And the last thing is make sure you fill out that survey that will pop up once this webinar is closed. So from us at QBCC, thanks very much for attending, and we'll see you at the next one. Thanks very much, guys.
Thank you,
See you later.
everyone.
Bye-bye.
Bye.